What's up, everybody? Welcome to the November 17th, 2025 IndiView Weekly Market Update. I'm Jeremy Bryan, and this is powered by IndiWealth. Today, we're just going to get right into the hot button issues of the week for the market, so let's get going. Let's start here. I was wrong. Let's start with that. That I was wrong with regard to the shutdown last week. I said I was a little more skeptical at the beginning of the week when we were talking about it. Now, it ended up passing pretty quickly through the Senate. But what I had said was there were no healthcare subsidy extensions listed as part of the agreement plan. And I thought that might have Democrats a little more questioning about whether to do it or not. But they chose, 8 Senate Democrats chose to go to the other side or go with the other side, and have agreement. And now we have a government that's at least somewhat functional here at this point now again. Why I say data maybe on here is we're starting to hear some indications about, hey, this data might be incomplete. This data might be missing to the bins of history forever since we were in the longest government shutdown ever. So data is going to trickle in a little bit more, but I think we are going to get back to at least getting the data we use to make assessments on the economy and about what's going on in the job market. All that stuff is going to slowly come back. It just may not be fully functional here in November. Why that's important is that the Federal Reserve, if you've listened to commentary lately, over the past couple of weeks, they've really started to adjust towards a more, hey, don't consider December a lock. Now, that started probably after the last meeting when they did cut rates. They were saying December is much more questionable and that kind of stuff. And they've really kind of amped that up now. I think they are seeing some, again, they didn't have government data because we were shut down. But some of the alternative data they were seeing and some of the data that we're seeing is showing that inflation might be still working its way around that 3% annualized rate. And to have another cut during that period of time might be a bit of a question. Now, again, you have to offset that. The dual mandate of the Fed is controlled inflation and jobs. And we haven't had a lot of jobs data here recently, but the data that we are getting, the alternative data, has suggested further weakening. So again, there's just this dichotomy they need to figure out. They're in a little bit of a tough spot right now. And I think that's why you've seen the probabilities were very high for 2 cuts. If you were looking at September and October probabilities, it was almost 90% in both that we were going to have 2 cuts by the end of the year. Now we're much more of a 50-50 proposition for this next cut. So I think that's actually right. I think, I said that right as soon as that meeting was done and saying we probably shouldn't assume that this is going to be, December's going to be a slam dunk from that perspective. Again, one cut, one stay doesn't really change the course and the trajectory of human history nor in economic history. It is largely a sentiment-driven thing, and understanding what the market's going to look like. It's not 1 quarter basis point does not really change the world all that much, but the sentiment change does a little bit. And so how it relays is really right now, again, we're a little bit in limbo with regard to what the direction of the Federal Reserve will be. And also, as we get more government data, now we'll start to assess, okay, what are the jobs reports actually telling us now that we're having more concrete data because the government's back up and running. Turning to number 2, we're in a Bitcoin bear market. I looked this morning, I think the drawdown, which is the percent decline from peak, is now more than 20%. I think it was close to 25% when I looked this morning. It might be a little deeper than that. But clearly, we're in a bear market of more than 20% decline in Bitcoin. This happens all the time. If you look at the annals of history from Bitcoin, 20 and 25%, historically not that big of a decline. For the stock market, that's a relatively substantial decline. I mean, and even for Bitcoin, it is. It just happens more frequently. And the level of magnitude of decline in Bitcoin, again, the volatility that you pay for having this is much more substantial at this point. Even now that that's calmed down a little bit, it's still more substantial in the overall market. I mean, we've seen multiple 50% declines in the Bitcoin over the long periods of history. So it is still there. It is still, they're trading it aggressively. It's just in this current or in bear market territory at this point right now. I don't read a lot of assessment outside of the fact that I think people are starting to get a little less comfortable with risk. Again, this can change on a dime, and I'm not saying that this is an overall strategy adjustment or allocation adjustment from this, but we are seeing, Nasdaq numbers and AI oriented stocks started to face a little bit of weakness. They haven't been as robust as they have been. They had a little bit of a pullback here recently. And you're starting to see it in some of the data of, especially debt-laden AI companies, that some of their debt is pricing a little bit higher. I think just the appetite for risk is saying, okay, I don't have quite the appetite I had before. I'm going to pull a little bit of risk back. And that usually centers around the stuff that's worked extraordinarily well or the stuff that's extraordinarily volatile. And in this case, Bitcoin fits that realm. It hadn't had the phenomenal year. I mean, gold is far superseded from a performance perspective the year of Bitcoin. And now with this decline, Bitcoin's actually negative year to date. So again, this is a highly volatile asset. This is something that has some scale of correlation differential. I did look at the correlations today. And if you go back to, now again, this isn't very long at all, but if you look at the history of just the ETFs, IBIT being the one, probably the biggest one, to the Nasdaq and the QQQs, there is a correlation, but it's actually relatively low. It's about 0.39%. So it is not a one-to-one that they go up and down together. But in a risk-off situation, I can see both of these kind of pulling back. And Bitcoin, honestly, just right now has been the more aggressive pullback. Turning to earnings, wow, we got two big ones this week. We've got NVIDIA, which obviously everyone knows, largest company in the world at this point right now, and poster child for AI infrastructure deployment. We'll be really interested to hear what they have to say. We are owners in our Indy stock portfolio. We do own a piece of NVIDIA. We don't own anywhere near what the S&P 500 owns. The S&P 500 is about 8% or 8% plus maybe at this point now. We are substantially lower than that. So we have a much more broadly diversified portfolio of other sectors and industries. But we do own NVIDIA, and so we want to understand what the growth rate looks like, what the trajectory, are they accelerating, what is going on in the deployment phase, because that is still where NVIDIA makes most of its money. And it's still where people look to it and saying, if there's something that happens to this thing, it will be in that phase. So I don't foresee any of that. I think they're going to talk very robustly about what the situation looks like. AMD was just out and gave very robust numbers. I would assume NVIDIA talks the same. We'll see. The other one that's really important to me, and there's a broader swath of consumer companies reporting, but obviously Walmart is one of them. Some of the Home Depot and Lowe's are reporting and those things as well. But we get a little bit more of a sense of the consumer. Again, going back to what we've been talking about with the K-shaped economy, right? Is that the higher end is doing better than the lower end. That's really all the K-shape means. From an income perspective, higher incomes are doing better than lower incomes at this point right now. We'll see what Walmart has to say about that, because Walmart tends to be that median to lower income household level. They've been floating into the higher income via the delivery systems and things they've been investing in. But overall, it's really a good broad swath about what's the economy doing, especially for quote unquote Main Street, because Walmart is synonymous with Main Street. And a lot of the retailers reporting this week are synonymous with Main Street. So I'll be paying a lot of attention to what they're saying. Turn to the personal side. I wanted to just quickly talk about the New York Times. I'm a subscriber to the New York Times. And I'm starting to think about 60% of the reason I subscribe to the New York Times is because of the games I play on there. Wordle, everyone knows Wordle. I'm not breaking new territory there. But Strands, Connections, Pips, all these games that they have on there, they've really done a good job of building an ecosystem of low maintenance, quick hitting games that just kind of allow your brain to fire a little differently. None of them are a heavy lift. I mean, you can make some of them, the aggressive ones. If you want to play the crossword, I'm terrible at big crosswords. I play the mini one just because I do like doing that and see if I can finish it in under a minute. But outside of that, I don't play the big crosswords. I don't tend to do the very hard puzzles because I don't want to spend the time to sit there and do it. Maybe a skill thing too. I don't know. But I tend to like that realm between, 1 minute and 5 to 7 minutes to spend on something within there, just to kind of get the brain firing in a different way. And I think New York Times does an excellent job of doing that. And again, thinking as a subscriber, it's going to be tough for me to get rid of that unless I find a substitute somewhere else. So if you all have any indications about where I could get my gaming fix that's outside of the New York Times, I'm all ears. That's all I have for you this week, though. Tune in next week where we'll have our next hot button topics. Until then, thank you very much and take care.